So, let's kick this off with a bit of a thought experiment. Imagine your company is worth massive amounts of money, you've got deep roots in your community, your customers are all local, but then suddenly, your government introduces a heavy new tax on your wealth. Take a look at what's been proposed for the November 2026 ballot in California, for example. Proposition 40 is a one-time tax of up to 5% on certain taxpayers with assets over $1 billion. Honestly, it's human nature to think, if they're going to tax me that much, I'm taking my money and I'm out of here. But is that what actually happens in reality?
You'd probably think it's a no-brainer, right? When governments target the ultra-rich, the common assumption is that they just pack their bags and flee. But when we actually dug into the global data, we found something that kind of blew that whole theory out of the water.
Welcome to episode 2 of our Global Wealth Explainer series, where we are breaking down the myth versus the reality of global wealth mobility. Before we really get into the weeds today, make sure you hit that subscribe button so you don't miss a thing as we navigate these massive shifts in global finance.
All right, here's our roadmap for today. We're covering the wealth migration myth, what leaving actually means, India's strict tax residency rules, the new era of offshore visibility, and finally, the real wealth equation. Let's just jump right in.
Starting off with Section 1, the wealth migration myth. We have all seen the sensationalist headlines claiming that billionaires and millionaires are fleeing their home countries in droves to escape high taxes.
Well, it turns out this mass exodus is pretty much a statistical myth. Take a look at this quote from a brilliant 2025 Tax Justice Network report. Notice that near 0% part? It turns out the media frenzy, which was literally pumping out like 30 news pieces a day last year about a supposed millionaire exodus, was wildly overblown.
To put that into perspective, remember when the headlines screamed that over 9,000 millionaires were abandoning the UK? It created massive panic. 9,000 sounds like a huge exodus, but actually, that was just a microscopic 0.3% of the UK's total millionaire population. The data firmly proves that changing your physical residence strictly for tax purposes is incredibly rare. Which brings us to Section 2, what leaving actually means. Because to really grasp this, we have to completely untangle moving your physical body from moving your money.
Look at these two very different buckets that constantly get confused. On the left, you've got your personal residence and citizenship, meaning where you physically sleep at night and what passport you hold. But over on the right, you've got your investment and business location, where your companies and your assets actually live. You can totally stay in your home country, keep your citizenship, but legally set up a fund or a business somewhere else to diversify. Moving your money abroad absolutely does not mean you've legally packed your own bags and left the country.
Moving to Section 3, let's look at India's tax residency rules to see exactly how governments enforce this on the ground.
And hey, real quick, if you are finding this breakdown helpful and want to keep decoding these global tax laws with us, go ahead and drop a subscribe right now. We absolutely love doing the heavy lifting to make these complex legal mechanics clear and accessible for you.
Okay, so let's look at the actual laws. Under Section 6 of India's 2025 Income Tax Act, just buying a plane ticket to Dubai doesn't magically wipe away your Indian tax obligations. You've got these super strict physical tests, like hitting a 182-day physical stay in India, or the 60 days combined with 365 days over the previous 4 years rule. There are even deemed residency traps for Indian citizens earning over 15 lakh rupees who aren't taxed somewhere else. And then there are criteria for being not ordinarily resident, or NOR. Think of NOR as kind of a unique transitional bucket for returning Indians that limits how your foreign income is taxed without completely severing your tax ties to India. The bottom line here, your tax status is tied down by rigid legal math, not just your mailing address.
All right, Section 4, the offshore visibility era. And this is a massive reality check for anyone thinking they can just use mobility to hide their capital. The old Hollywood idea of stashing cash in a secret island bank account, it's completely dead. Now, countries absolutely allow you to move money legally. For instance, under India's liberalized remittance scheme, the LRS, residents can freely send up to $250,000 overseas every single financial year for investments. You are totally allowed to diversify your wealth globally. But here's the catch. That legal diversification is heavily monitored. Every single dollar is tracked. Enter Schedule FA. Think of this as the government's financial X-ray machine. If you are an Indian resident with foreign assets, this mandatory disclosure forces you to list absolutely everything. Foreign bank accounts, equity, property, trusts, the whole shebang. The tax department knows exactly where your money is sitting.
The era of the invisible offshore account is over. Offshore no longer means invisible. And it is definitely not just India. Look at China, which just rolled out a harsh new 20% income tax framework on offshore trusts. Around the world, tax authorities are aggressively cross-referencing banking data and digging deep into complex corporate ownership structures. There's literally nowhere to hide in the modern banking system. Assuming an offshore trust makes you invisible today is a very dangerous, outdated mistake. So that brings us to Section 5, the real wealth equation. If the wealthy aren't physically running away in droves and offshore accounts aren't a secret anymore, why on earth do they stick around when a country threatens to hike their taxes?
Well, it boils down to this exact equation right here. Taxation is just one slice of a very complex pie. When making these massive life decisions, wealth creators are balancing that tax bill against their access to customers, the predictability of regulation, their family's lifestyle, and physical security. More often than not, the ecosystem of opportunity and the extreme cost of uprooting an entire business heavily outweigh the cost of just paying a wealth tax.
Savvy governments understand this delicate balance perfectly. India realizes it, which is exactly why we see their 2026 amendment bill. Instead of just focusing on squeezing taxpayers, they are aggressively slashing red tape to pull global fund management back into the country. They've scrapped the strict 25-member minimum for offshore funds, ditched the 10% single investor cap, and tossed out the 100 core minimum corpus rule. They're making the regulatory environment so incredibly attractive that capital naturally just wants to stay put and grow.
So, what should you actually take away from all this data? Let's walk through these 4 core lessons. First, never confuse legal tax planning with illegal tax evasion. One is a smart business strategy, the other is a literal crime. Second, you absolutely have to understand your actual residential status under your specific local laws, like those Section 6 rules we looked at. Third, report everything. Strictly follow your foreign asset reporting obligations. And finally, recognize that owning foreign assets for diversification is completely normal. It is not the same thing as capital flight.
Ultimately, complete transparency is the new global standard. But that leaves us with one massive, completely unresolved mystery. If the rich aren't migrating their physical bodies, but their investment portfolios are legally expanding and diversifying all over the globe, where exactly is all that offshore capital flowing right now?
Well, that is exactly what we are going to explore in episode 3 of this explainer series, The New Global Money Map. If you want to follow the tax and see where the world's wealth is really being parked, hit that subscribe button, and I'll see you next time.